Welcome, Aruhn. This is the Real Relations podcast by me, Gabe. And one of the things that I really want to talk about on this channel is just wealth in general and having a substantial knowledge base on it, just knowing to do within certain uh, scenarios involving wealth. So you at one point were a practicing tax lawyer. Is that correct? Yeah.
Yeah, more or less. I didn't practice for very long, but I was a member of the bar and I did tax returns for a while.
Mhm.
So I guess you could say that. I never try to claim that because I think there's people who have done it for a long time, put many
Yeah.
years into it. I did it for maximum a couple of months,
Uh-huh.
but I guess I've done stuff even after that, just in terms of doing small business tax returns,
Mhm.
etc. But I wasn't full tilt into it like 50-hour weeks and stuff like that.
Yeah.
So yeah, I guess you could say that though. I guess I am still a member of the bar and I still could be doing that, but I don't.
Okay.
Yeah.
So that is awesome. You are a professor at the University of Texas and are currently teaching me in one of my classes, which is a tax class. And well, you have just like quite a bit of knowledge like within tax and within tax laws, tax principles, and the way just tax works in general. Is I know it's like a very like mundane subject at times, and people are like, oh, taxes, it's like the last thing that they want to think about. But I want to read this quote from Tom Wheelwright's book Tax Free Wealth, and it basically talks about how he sees taxes. So the average person in a developed country spends 25 to 35% of their life working just to pay taxes. That means more than 2 hours of every workday are dedicated to feeding your government, and 3 to 4 months out of every year are spent solely so that you can pay your taxes. That adds up to 13 years in your work life and 20 years in your lifetime. 20 years, that is a prison sentence. So, I think like sometimes there's like talk about like big corporations and like how they're doing it, and I want to delve into that a little bit more. But first, I kind of want to talk about a little bit more on some of like your more day-to-day scenarios. So like your average mom and pop, your average W-2 worker, your average contractor or 1099, and kind of delve into those scenarios. But sometimes tax avoidance, which isn't illegal, is that correct?
That is correct. Yeah.
And tax evasion is.
Yeah.
So tax avoidance is sometimes like frowned upon or not looked at the best light. So I just wanted to mention that stat so people could kind of think about it in a different light. I think of taxes more as there's certain benefits to the tax code, and if you're just ignorant on like what the benefits are to you, you aren't able to claim them. So the tax code was written to encourage entrepreneurship, to help business owners out, and then to also get the most amount of money with shaking the least amount of bees.
Hmm. Yeah.
So these were all concepts that I started learning from your class, and I just want to have like your tidbits on it. Like, what are your thoughts on how people should view tax?
Yeah. I think that that's a really good introduction. I think I really like that quote, by the way.
Mhm.
And I would say a lot of what makes the tax law and the practice of tax maybe more mundane is sort of the stuff that can lead to opportunities to minimize your taxes. So it's kind of like a general life lesson that if you're willing to do the boring stuff well, you could be successful. And I think that's definitely true with tax.
Mm-hmm.
So I think there's there's a number of things that I think, well, just before that, I would say also there's a Scott Galloway, who's like a business school professor. He's like an influencer, actually. He's like Professor G. I forget. He's got a blog and stuff, but he has this whole Columbia Business School discussion where they basically ask him like, what do you think is a good career? What do you think is the best career? And he's like a tax lawyer, and he has nothing to do with taxes. He's like a marketing professor, or I don't even know what really he does. And they're like, why would you say a tax lawyer? That seems weird. And it's like, well, basically they don't have to do that much, and they get to travel the world, et cetera, and make a lot of money doing it. And so I think it's sort of a humorous thing. So I'd encourage your listeners and you to maybe look it up.
Mm-hmm.
But it's just one of those things where it seems like a lot of people don't know about it. They think it's mundane, so they
Mm.
go the other way. They basically
Mhm.
just run the opposite direction. And so I think that, yeah, a lot of the complexities, a lot of the mundane stuff is sort of what provides opportunities not only for individuals, but businesses to essentially minimize their taxes in totally legal ways. There's nothing wrong with some of the minimization strategies that you'll see. And yeah, I definitely think that complexity is an opportunity, but it's also the biggest, I think, deterrent for the
Mhm.
average person. So when you're talking about like average business people or, W-2 earners, a lot of them sort of freak out when they start thinking about taxes. And I've seen a number of people, I've talked to a number of people who are like, you know what, this is getting so complicated, I'm just not going to file my taxes. And
Yeah.
so that's the worst decision in the world, but I can sort of understand the frustration, right?
Yeah.
I think it's sort of like trying to read a medical bill, like that's very frustrating if you're not whatever, a medical biller, because it just seems overly complex and you don't really know how much you owe. So I totally agree with a lot of that. I'd also say that there's one thing to keep in mind is that there's many opportunities that are totally legal, totally legitimate that people just don't know about.
Mhm.
And then there's other things that are aggressive. So,
Yeah.
and those things are, I wouldn't necessarily classify them as tax evasion. I tend to view these things more on like a spectrum, like gray area. So it's
Mhm.
not, I wouldn't say that this is tax evasion, this is legal tax avoidance. It's more like you can take more and more aggressive positions. And at some point, if the IRS decides that what you're doing is too aggressive and they win, then it becomes illegal. So it's
Yeah.
kind of like beforehand, you don't know if it's illegal. I mean, there are some things that are illegal, but
Yeah.
a lot of times what happens is you take an aggressive position that isn't clearly illegal. Maybe there's some tax professionals out there who would sign off on that.
Mhm.
And then when the IRS comes around and you lose in tax court or something like that, then you know it's illegal. Does that
Yeah.
make sense? So,
Yeah. So I think it starts getting a little bit like, so I want to talk about that spectrum a little bit more. You talk about that there's like the very specific, like these are like run of the mill things. These are like the deductions that almost every business is claiming. Then these are like tax strategies. Then these are like tax strategies that are kind of just meant to just save taxes and
yeah.
not have any benefits to the company. And you were talking about different court cases in class on how if there's like tax vehicles or like different corporate structures um that are solely made to avoid taxes, the IRS will see that and go like, that is a no-go.
Mm-hmm.
And they will audit you. They will bring out their big legal team and they will try to enforce some money out of you.
Mm-hmm. Yeah, definitely. There's definitely, and I think that that's more of a practice among larger businesses,
Mhm.
but definitely your large publicly traded companies have huge tax departments
Mhm.
that are very well compensated to essentially structure transactions, whether it's M&A or just some sort of expansion. They're all
Mhm.
structured in order to, I would say, minimize their corporate tax payments, especially to the US government. And the funny thing about that is that you think the IRS comes out for them, but they don't, even though a lot of these transactions are pretty clearly, like if you understood the details, you would say, wow, that's just completely brazen and an aggressive attempt to minimize your taxes. There's no reason to do that except for tax evasion, essentially.
Mhm.
But those things don't get prosecuted as much as you'd think because the IRS is really under resourced. Now, nowadays it's a little bit better because President Biden has sort of prioritized putting more money into the IRS. But for a long time, especially under President Trump and even maybe a little bit before that, the IRS really wasn't getting the resources it needed to pursue wealthy or large corporate taxpayers for their tax evasion. And in particular, that was true for those two groups because they tend to have the ability to hire the high priced lawyers and accountants that are able to make things complicated enough or burdensome enough to where the IRS doesn't even want to litigate that because it's a huge
Mm.
fixed cost for them.
Yeah.
So for a long time, we saw litigate, and we still see this, the IRS litigating against maybe middle income taxpayers, or even some low income taxpayers for stuff that you wouldn't feel too good about if you saw what they were doing. But they want to get wins. They're
Yeah.
not necessarily about maximizing tax revenues. They're lawyers at the end of the day. And if they have a bunch of losses against Amazon and Google, that doesn't look good on their record.
Mhm.
So yeah, it's sort of a perverse situation, but I
Yeah.
think it's maybe be improving a little bit right now.
Yeah, I remember there was like some news article that I remember reading. It was like the IRS is auditing some government agency. I think it was like FEMA or something like that.
Yeah.
Is it
I think it was
FEMA?
the FDIC maybe.
Okay, yes. And,
Yeah.
and so I thought that was like just a hilarious concept. Like
Yeah.
you have
Oh no, you're right. It was Fannie Mae or one of those. Yeah,
Yeah,
I forgot what that company. I
let,
remember that. Yeah,
let's search it up.
it was a public-private partnership of some kind. Yeah, they got
Yeah,
to pay their taxes too.
yeah.
Yeah.
So the IRS audited. Uh, can't find it. Anyways, but yeah, I think it's funny because like the IRS audits everyone. But I remember one time I was speaking with a mentor who is a wealthy real estate investor, and he was talking about. I was talking to him about some of my deductions,
Mhm.
and I was like, dude, I'm terrified of getting audited. And he's like, I don't know, dude, you're making like 18,000 this year.
Yeah.
I don't think the IRS is gonna try to nuzzle like an extra $1,000 out of you. Like it's not like IRS agents have to make a certain amount of money to make it worth their time because it's true they still have their costs, they're still understaffed, and they still have to do certain things. I mean, if it's like blatantly obvious, like fraud,
Sure.
or if it's like anything that's like also in that gray area that triggers like some of their audit triggers, and some of the audit triggers include having like exact number deductions. So an example could be like $2,500 exactly, as opposed to 2536 with 27 cents.
Mm.
And then I know Tom Wheelwright talked a lot about audit triggers within his book. So if anyone wants to learn a little bit more about that, his book is a great resource. But I remember I was like listening to this and I was like, oh, these are like different ways that I could think about like audits. I was like, oh, they're not scary. I just have to prove whatever I'm actually doing. It's not illegal. It doesn't mean you're in trouble immediately. It just means that if you're doing some sketch stuff, you're going to have to back it up. And if you can't back it up, then it is illegal.
Yeah, and I would say, I mean, I think the idea of audit triggers. I'm not sure when that Wheelwright book was written, but the audit triggers are kind of not. I think people used to think that these things are audit triggers, but it's really different. I think nowadays. I mean, people typically would say like a home office deduction that's large
Mm-hmm.
is going to lead to an audit,
Mm-hmm.
and that makes some sense. But I think the state of the world right now with the IRS is that they have their own proprietary black box algorithm, and it's not easy to necessarily predict what's an audit trigger. Some things are just obvious, right? If you have a charitable deduction that's 50% of your age of your taxing, let's say taxable income, I don't know,
Mm-hmm.
we call it AGI or something like that. That's gonna trigger something potentially, but that's more obvious. There's no specific thing that it's harder to know specific things that are like, let's say, a particular transaction or a particular deduction that's going to raise eyebrows. It's more like, is what you're doing different from what a lot of other people with your same situation are doing? Because they essentially have all of our tax returns and they compare. And so if Gabriel has a huge charitable contribution deduction and I don't, but we make the same amount of money, we work at the same place, that's going to be more likely to be an audit trigger than, or maybe
Yeah.
we donated to the same charity and you somehow have one that's 10 times bigger than mine. That could raise some eyebrows. People with a lot of business income and a lot of deductions,
Mm-hmm.
that's going to generally trigger some sort of audit. And like you were saying, a big thing to note here is audits are not meant to be necessarily scary, but they are when you get a letter from the IRS that says, hey, you have a deficiency or we think that there's some taxes you missed. That could be scary. But a lot of times they'll send you a letter that just says, we think you miscalculated, because sometimes you just literally forget a zero when you're filling in your tax return. That
Mm-hmm.
happens all the time. And those are not supposed to be scary, but it all sounds the same. So yeah, it's sort of a process. If you're willing to, again, be sort of, I wouldn't say courageous, but if you're willing to be aggressive in maybe taking on the IRS and maybe pursuing litigation if you need to, et cetera, then I think just having good documentation for every deduction you're taking is probably the biggest thing you can do. And I can't give tax, actually, I'm not allowed to give tax advice, but informationally, I would say that that's the biggest thing is just documentation. And some of it's obvious, right? I mean, if you have a charitable contribution deduction, you make some donation to Goodwill, they give you the little slip and you're supposed to fill it out, right?
Mm-hmm.
You better have that slip. And it's a good idea to, if it's a lot of money, to have sort of the things that you actually donated, not just a bag of clothes that you're now saying is worth $10,000, right?
Mm-hmm.
So it's got to be, the more documentation you can have, the better. But with documentation, these audits are typically not necessarily bad for you. You may not actually end up paying back taxes. Now, it is burdensome for the average taxpayer to get audited. to have all this documentation. That's not easy to do. So one thing to note here is, yes, there's tax payments, and then there's other costs like legal costs or just headache costs, right? Do you really want to keep track of every receipt that you ever had, stuff like that?
Mhm.
So you kind of have to do that for yourself. I mean, some people are willing to say, I've heard it said, I've talked to non-tax people about this, and people say, why would I spend so much time, especially in a small business, keeping track of every deduction, every receipt so that I can minimize my taxes instead of spending that time thinking about how to grow my business?
Yeah.
Because if you grow your revenue, that's a lot better than minimizing your taxes in terms of your after-tax cash flow. So I'm sure you've heard something like that.
Yeah.
And that I think that is probably true.
Yeah.
Does that make sense?
Yeah. No, there's I think Alex Ramosi talks about how one of his like rich friends moved to like Puerto Rico, but now he has to wake up at 5 a.m, go to his private jet, and then fly. And it's just to avoid taxes. And he's like, I don't know, man. That's like, you don't think that time like spent in the plane and like just like traveling and commuting, you
It
don't
is a
think
private jet, though. But.
yeah, it is a private jet, but
Yeah,
he's like, you don't think that time could just be better spent like trying to grow your business and instead of like trying to get rid of that. But I wanna talk a little bit more about how complicated it is because I have my mom and she works at one of these like sketchy second I'm sorry, mom, for dissing you, but like she works at like this company that does like personal loans for like second chance loans.
Okay.
But I don't think like the people that really are needing these loans like should start getting these loans.
Okay.
It's always like a tricky scenario whenever I'm like talking to her about personal finance and like her job. But she also does like personal tax returns.
Oh,
So
cool.
she does like a lot of 1099s, W2s. But a lot of the times I'm speaking to her and she's like confused. She says, I remember she was like talking to me about a couple of 17-year-olds that gave her the 1099 and they're like, "Where's my return?"
Yeah.
And she had to like deliver the bad news that they have to actually come out of money, like come out of pocket, like to pay. And everyone like they thought that she was scamming them. And I don't know, it's always like this ordeal. And this happens like a lot in like smaller communities like Eagle Pass. I'm from Border Town. There's not much financial literacy. The financial aspect isn't really talked about. You learn what you're raised with, but like what you're raised it with is like a poverty stricken town.
Yes.
So it's like they just give out bad financial tips. So what would you say is like one of the easiest ways to break down taxes to like the most to the college kid or the kid going to college, 17, or not even going to college, just graduating high school? They're 17, they don't know what to do. They just know they made money, they have a W2, 1099, or they're even starting their own business. Let's start delving into that scenario and what are the different things that we could do to better help those people tax wise.
Yeah, I think that the first thing I'll say is that if you sort of have any sort, sorry, say that again.
Wait a second. I'll also grab a notebook, so if you need to draw anything.
I'm not, dude. I'm a you could draw for me though,
Okay.
and maybe you can draw. That might help me, but I don't know. So I would say like the number one thing that if you make money of any kind, it's not a terrible idea to try to file a tax return. And I think that the IRS this year in particular has made it a little bit easier. So President Biden passed some essentially legislation that made direct filing at the IRS's website possible. It's a public-private partnership. So I forget the website, but you can just sort of Google IRS direct file or IRS tax return.
Mhm.
And they have their own filing system now where you can just file directly on their website and submit it. And that I think is useful to people who are kind of like, well, where do I even start? Like, do I have to go download some forms and print them out? And if you don't really know where to start, I think that that's a good idea. The IRS actually, the website actually has a lot of resources on first time taxpayer, like what we should do.
Mhm.
But I think in terms of things to note, at least let me put it this way. If you don't know that you have to file taxes, you pretty much have to file taxes if your taxable income is greater than some number, which is often your standard deduction.
Mhm.
So that's something that is going to be specific to each person. If your taxable income is somehow lower than that, or let's say your gross income minus some deductions is somehow lower than that, you typically don't have to file a tax return. They won't do anything about that. But it's not a bad idea just to fill it out anyways, and you don't have to submit it, but just make sure you're on sort of a path of knowing what to do. Because maybe in the next year you are going to make enough money. You don't want to just have to one day do everything all of a sudden, right? That would just be painful. The other thing I'd say is a lot of times if you're a W-2 wage earner, people tend to think, like in the anecdote you were giving, people tend to think that, crap, I don't have to file taxes, I didn't make that much money. But if your employer is withholding income, you might be eligible for a refund.
Mhm.
And sometimes I've heard of situations where they'll send you a refund without necessarily a tax return that you filed. But if you want to make sure you get that refund, it's always good to file a tax return. You see what I'm saying? So I think that that's one thing that I've seen a lot of people maybe miss out on.
Yeah. So if you're a W-2, you have a refund for 1099 or like someone's side business. Um, you say to still do it because like sometimes there are deductions that help like offset some of the actual income produced.
Yeah, I would say that. And I would also say that you're still supposed to do your own withholdings if you're self-employed.
Hmm.
So if you have been doing that, or let's say you have some sort of payroll agent who's doing that for you,
Hmm.
there may be a situation where you still could be eligible for a refund, even with a very low amount of taxable income or zero taxable income. So it's not a bad idea just to get in the practice of it, of filling out your taxes and maybe not submitting it if you don't have to, but
Hmm.
making sure you're not owed a refund. And real quick, before we say something else, the other thing I'd say is a lot of times there's employment taxes or self-employment taxes that you have to pay. And if you don't file because you have a low, let's say, income, so you think I don't owe any income taxes, if you haven't paid employment taxes, and especially if you're self-employed, that could be a problem because those are owed too. And so you need to make sure that you maybe don't fill out a tax return, but at least you have paid them, because
Hmm.
otherwise you do owe them money. So that can be a problem. So a lot of people think, well, I'm doing this income tax return, I don't have enough taxable income. But if you haven't paid your employment taxes or your self-employment taxes, that's going to be a problem for them.
Yeah. So I remember there was like this example that you gave in class. The person picking up $20 on the street.
Mm-hmm.
Do you have to report it to the IRS?
Mm-hmm.
And you're like, you made us all vote, and then there was like a discussion. So it was like, if you found $20, you have to do you have to report it to the IRS? And you said technically you do have to. However, there is certain things that people just don't file because it's like mundane. It's like, oh my goodness, am I gonna have to go through like every single money or like form of money that I've received? And you talk about that concept sometimes. So if someone's just starting out their business, if someone's just starting out like their OC, their little side hustle, do they technically have to report, or is it more so something that you should do once you start gaining like a certain threshold of money?
Yeah, so that's where I think if it depends sort of the scale we're talking about here. There are de minimis exceptions for like the $20 bill.
Hmm.
Technically, that's gross income, but the IRS wouldn't ask for it. They have rules basically about when they want you to report
Hmm.
items because they don't expect you to report like a penny you found in the sofa or whatever.
Hmm.
So, but yeah, for a small business, I think if you're making taxable income, it's a good thing to take a look at your tax return just to maybe get yourself ahead of next year.
Hmm.
It's not a bad idea to ever do that, but you know, yeah, if you make a substantial amount of money, then yeah, you definitely need to file your taxes,
Yeah.
right? And I would say the minute you start making a good amount of money, it's good to start looking at your requirements, because a lot of times you do have to withhold some money every quarter.
Hmm.
And if you're not doing that, there could be issues at the end of the year. So you typically want to make sure that, and maybe this is going backwards a little bit, but let me just
Hmm.
state this. So the way the tax system in terms of collections actually works is that yes, we file a tax return at, April 15th, it's coming up, but throughout the year, every so often, you basically have to pay a little bit of your expected taxes. So whatever your taxes that you think you're going to owe, you're basically paying a little bit of it. So if you're like self-employed, it's usually quarterly.
Hmm.
Let's say you have a side hustle, you have a business. Technically, if you're making money such that you're going to pay taxes at the end, you have withholdings every quarter. And so you're paying a little bit every quarter. So a lot of times, if you're not paying attention to that up front, you might have missed the first 2 or 3 quarters. But at the end of the year, your withholdings and have to roughly equal your taxes.
So is that only when you have like an LLC and you're a small business, or is that 1099 as well?
That's 1099. That's any self-employed individual.
So you have to withhold a certain portion of tax. And,
Yes.
Huh. I didn't know about this. So what is, do you know what that's called?
It's just like, I think in terms of the form, let me just look it up. You could probably, I don't know where the form is, but I guess you could look up like,
Is it a 1040? Form 1040?
well, that would be the individual tax return. Let me just see here. There is a self-employment tax. Let me just double check here. You know what? It's going to take me a minute to figure this out. But in any case, if you're definitely if you're self-employed, you have to have some amount of withholdings. Usually quarterly, usually is what it is. So if you have a W-2 and W-2 is basically you're employed by somebody else, those things are going to be the employer withholds for you. And so basically those withholdings, whether you're self-employed or not, have to roughly equal what your tax bill would be at the end of the year. So that I think is important. That's where I think if you're making money as, let's say, an LLC, let's say you're whatever kind of business you want to be for tax, you do need to start paying attention to that, because if you don't, then you're basically going to not have any withholdings at the end of the year, and it's going to potentially be a problem.
Okay. So what you're essentially saying is that you should, like, if I'm making $2,000 and my self-employment tax is going to be roughly around 20%, I should start like putting 20% of like my paycheck, and then after that claim my deductions and use the withholdings that I have to pay? Or is it separate from you having your own fund to pay taxes?
It's separate from that. So I guess the best way to think about this is, let me just give the example of like a W-2, because that's when it's easiest to understand. When we're talking about independent contractors, let's say you're getting a 1099 versus a business, like those things are a little bit different, but the concepts are pretty much the same. So when you get a W-2, you have to pay employment taxes. You have to pay your share of the employment taxes, which is like what we call the FICA, which is like your Social Security, Medicare, whatever that is. Those things are just basically taken out. Usually they're taken out. Another part that you'll see is on your W-2 is your withholdings. And so your withholdings are not related to employment taxes. Those are related to income taxes. And what those are is the federal government taking a little bit of your paycheck basically every 2 weeks or every month that you get paid, so that at the end of the tax year, you don't write them a big check. So basically, like, let's say just to provide some numbers on this, and this is excluding the employment tax. Let's say you made $100,000 this year. And let's say your tax bill, is going to be $20,000. You basically need, what the way the W-2 system will work is they'll take out a little bit of every W-2 paycheck that you're getting. And at the end of the year, it'll be pretty close to $20,000. So when you file your tax return, a lot of times you don't have to write a big check. You don't write a check to the IRS for $20,000. It'll be like $500 because they've already withheld a ton of your money already. You see what I'm saying? Now, if you're a business, you have to do that yourself, because if it's a W-2, the employers do that. That's called withholdings. If you're a business, you have to make quarterly payments yourself. So you kind of have to do your own estimation of that.
Yeah. So I guess like here I'm getting a little bit confused with the different types of taxes. There is a boatload of taxes. So we have the regular. So once we make like 100K, that is our gross income. And then we have our taxable income. Is that correct?
Sort of.
Okay.
You can think about your gross income as all the money you got.
Yeah.
All your, what we learned in class, like accessions to wealth, or all your revenues, if you want to think about it more of an accounting way. So it's sort of like all of your top line, everything you made this year. That's usually what gross income is.
Yeah. So everything you made is your gross income, or some people consider it like revenue.
You could call it, like, revenue would be one type of gross income. Let me put it that way. If you're a business and you have revenue, that's going to be included in your gross income.
Okay. And then, so what is like the taxable income from that? Is is it just like the all the revenue that you received minus the deductions?
Yes.
Okay. So from there, we have the taxable income. Are you saying that the 20K is separate from the 20K that you originally mentioned within employments, within like employee tax withholdings? Is that separate from the taxable income, or does it kind of contribute to removing like some of that tax liability or tax bill?
Yeah. So the taxable income number is it's going to be primarily used for the income tax. And you have to
Mhm.
separate that from employment taxes or self-employment taxes. The self-employment and employment taxes are taxes used specifically for usually social programs at the federal level, like Social Security.
Mhm.
And they have their own calculation for what part of your income, your W 2 wages, qualifies for those things. So a lot of times, what you'll see is on your W 2, you'll see like a number that says this is the amount that's we're considering your like wages that we're going to collect employment taxes on. And so they'll charge like 7 and something percent and 8 something percent, and they'll just take that out of that number.
Mhm.
Okay, so that's the first step. That has nothing to do with your income taxes.
Mhm.
The second thing is after that, then you have to do your whole gross income minus your deductions, and you get a taxable income number.
Mhm.
That taxable income number, this is very rough, so I don't want anyone to bank on this, but this is very rough. But you're going to multiply roughly your percentages. You'll apply your percentages to that to get your tax liability more or less.
Mhm.
And so that
Tax liability equals tax bill, right?
sort of, yeah, let's call it that. Tax liability is like your tax bill,
Mhm.
right? Now, the thing about it is, and it's probably better to think about it as a tax bill because it's not that you are going to owe that much
Mhm.
because you've already paid that much every year. So setting aside the employment tax, we already paid that, right?
Mhm.
There's also going to be another thing where every time you get a W-2, generally speaking, you can change this, by the way, but there's a withholding number, which is part of your taxable income number. Okay. So it's part of your income. They're basically just keeping a little fraction of your income. So hopefully at the end of the year, when you come to figure out your tax bill, it's very close to your withholdings. So they've been basically you can kind of think about it like they've been taking part of your money and putting it in escrow, or they're actually sending it to the IRS. And that number is going to be hopefully close to your tax liability.
Mhm.
So from your perspective as an employee, they took out your employment taxes, your share of the employment taxes, and they took out withholdings, and now you're left with whatever's left. Does that make sense? So there's two different taxes that we're talking about when we're talking about W-2s and 1040s.
Yeah, yeah. I feel like this drawn out is a little better. Can you attempt to?
I could try to draw it out if you want to just show like a W-2.
Mm-hmm.
That would probably be good. Like, is there a
Like a W-2 form. I could probably just like link it in like the
yeah, or like I could pull one up if you, or I guess that's not helpful. Or like, there's nothing. I guess like here, I'll show you, and you could tell me how to draw this. I'm down to draw it. I just don't know what to do.
Okay.
So this is how like a W-2 typically looks, right?
Okay.
This is all just so this right here. So see these Social Security wages.
Yeah, we're talking about part 3 and 4.
Yeah, so that's the withholdings for Social Security and
Okay.
and Medicare. But they also have this federal income tax withheld.
Mm.
So that's what I'm talking about here. Does that make sense?
Yes.
And this is your W-2. This is not your full tax return. This is just your W-2.
Yeah.
You see what I'm saying? So there's 3 different types of, usually these two are thought of this as the same, 4 and 6, because that's all FICA taxes.
Mm-hmm.
This one is a federal income tax withholding.
Okay.
So I don't know. Do you want to draw this?
I guess no. That would just like make sense.
If you could show this, I think.
Yeah, the W-2 form.
Yeah.
Yeah, and this is
the 2022, but this is just a W-2.
okay. Yeah, I guess for anyone who might be confused, like me, Form W-2 is a little bit easier to visualize and conceptualize.
Yes.
This. Okay, so one of the things that I did was that I've been looking into different questions about tax and asking different friends, and I've also had different questions from my mom and just some of the different ways. So we're gonna talk about like just some of the standard deductions that most people could write off, and then what are some of the benefits to being one way or the other. So being 1099 as opposed to W-2, as opposed to an LLC. And I also brought a graph to kind of help us. This was by Cody Sanchez. She is the founder of Contrarian Holding, which is a private equity company that helps business knowledge come to the world. And she was talking about how she was making over six figures as a W-2 earner, but now it's a lot better because she's making six figures as a, I'm not sure if she said S Corp or C Corp, but I remember she was in some type of LLC. And I want to break that down too, because you could file as an LLC, but there is an extra step. You have to find out what you are. LLC to what? And well, let's start with those.
Yeah, maybe we should, before we get to any numbers, maybe let's take a step back and talk about a few very fundamental things, right? So the first thing is that if you're in a business, let's say you're an individual, you have your own side hustle, etc., you have the option of making an LLC with the state, and that's going to entail certain costs and requirements. And then you can make an election with the IRS on how you want to be taxed.
Yes.
Those are two very different things. And I think a lot of people, this is where I think a lot of, and I did do some stuff with small business clinics and stuff. This is where a lot of people, I think, end up in some, I would say, tough situations, because you don't always need an LLC. Okay. So like I've seen a lot of people, especially in like the low income taxpayer clinic, et cetera, you have individuals who are trying to start a business and they immediately file for an LLC. They immediately have an LLC. Well, an LLC has its own costs, right? So there's filing fees, and usually those are relatively cheap, but they can be expensive. And they have very strict requirements about sort of what the corporate governance requirements, if you want to call them that. Like every executive, there has to be like a secretary, et cetera. You have to take some minutes in some states. It all varies by state law. A lot of times, if you're just an entrepreneur, you're trying to start your own business, that's not really fun. That's taking a lot of your time, because there's a lot of admin requirements associated with that. I'd also say that the benefit of an LLC is going to be what? Asset protection. So if you're an entrepreneur and you're worried that in case you somehow fail, your creditors, let's say you have a lot of debt, they could come after your personal assets, then it might be wise to form an LLC. But a lot of times what you see is a lot of these entrepreneurs, they don't have that many personal assets to begin with. So is it really worth it to go through the hassle of filing an LLC and all that just to get asset protection when you don't have that many assets to begin with? So I'm not saying anyone should do one or the other. Again, I can't give legal advice, but I will say that consider the trade-offs. Just get a full picture of this, which is that LLCs, the benefit is asset protection, which means your creditors, people can't come after you personally if the business fails and you have some debt, et cetera. But the costs it's burdensome. I think there's a lot of administrative burdens, which my mom is a doctor, and we had a family practice that was an LLC, and my dad was sort of in charge of it for a while. And he's not a business major, he's an engineer. And he was like, it was a pain for him. You know, we were paying a CPA to do a lot of the payroll stuff. So it was costly from that perspective. I think for him, he had a full-time job. He doesn't really want to do this. So you have to consider that burden there too. And so I tend to think like if you're really, really just starting out, you have to think about whether, is it really worth it to get an LLC? Do you really have that many assets to begin with that you need to protect? Does that make sense?
Yeah.
So consider that. That'd be my first thing. The second thing I would say is a lot of people jump to S Corps right away. S Corps, again, have a ton of burdensome requirements, right? So you have to think about, there's all kinds of little details we could go through, like reasonable compensation, all the filing requirements, et cetera. Is it really worth it for you to do that? Or is it better to just be a sole proprietorship? Right. And with the sole proprietorship, you're getting a lot of the same benefits, and there's some bigger benefits and there's some small costs too.
Yeah. So I want to go back a little bit. You said an LLC, you could elect it to be taxed or seen by the IRS as a certain entity. So they're like under this big umbrella of LLC, there are, if I'm not correct, correct me, but four. So there's sole proprietor, partnership, C Corp, and S Corp that you could elect to have the LLC viewed as. by the IRS. Is that correct?
More or less, yeah, more or less. That's right. There's a few details there that will. Let me put it this way: most LLCs, they could be partnerships or S corps, sole proprietorships. That's usually what you see.
Okay.
There's things like tenants in common, but those are sort of niche things. There's a lot more details than what I'm saying, and I don't want to misinform anybody, but the vast majority, a lot of times LLCs will be S corps or some sort of C, not a C corp, but usually a partnership or sole proprietorship, something like that.
Yeah, we talked about different things in class, such as tax shelters that are sold within like the big four accounting firms or like big companies like Goldman Sachs, and how there's been like different litigations
Yeah.
on those types of companies, how they've been kind of messing around with their corporate structures, and how they typically don't go after them typically. So this could get that being said, this could get very, very complicated. And like a lot of the times whenever you hear about LLC, like people are like, oh dude, that's like business bro stuff, and it's like finance bro stuff. It's like how do you make this how do you make this a little bit more accessible to someone that has like no idea what they're doing with this? Is it I know you were talking about like the regulations, but I feel like most people who own an LLC don't even know about like these regulations a lot of the times. It's like which ones are actually mandated and which ones are kind of just like skimmed by like most business owners, because I feel like there's also quite a bit of that in the within tax. Is that
Real world.
incorrect?
Yeah, I think with LLCs, it varies by state. So there's definitely going to be some sort of fee usually just for maintaining an LLC, filing to get an LLC. It could be big, it could be small. Again, I just think about myself as, and it's sort of difficult for us because we're both business majors. If you think about an engineer, because I just have experience with my dad and my mom, neither of whom are business majors. And for them, like even the simple fact of taking corporate minutes, which we had to do, was a big pain in the butt for them. They're like, what are corporate minutes? Right.
Yeah.
What and who's the secretary? Who's the corporate secretary? Like, what is that? Is that a real person? All of these things require some knowledge base. And yeah, you can go look on like LegalZoom or whatever. But what if that information is wrong? So what ends up happening if you're, let's say, making good money like my parents were, and they have a business, they don't know what to do, you end up paying a CPA a lot of money, or you end up paying a lawyer a lot of money. When in reality, do you really need an LLC in the first place, right? So when my parents did the LLC, when they started the business, I was in law school, and at the time I wasn't necessarily attuned to everything they were doing and real world practicalities. But I think going back, I might have been, my mom was a doctor, so there is some liability, like you can get sued as a doctor, right? So maybe it's worth it to have an LLC. But I certainly would have been more, I would have maybe encouraged them to think about the administrative burdens of having a business entity. It's not a simple thing where you just kind of wake up one day and you fill it out. There are ongoing requirements every year. And that depends on the state. That depends on, maybe they don't care. Like I think what you're saying is maybe they don't even check at the government level.
Well, what I think you're mentioning for LLCs and have like ongoing requirements, like I tried to convince my mom to kind of like start it, because like sometimes she's working in like big events where there's liability for her.
Okay, yeah,
and
that's a perfect. And she has personal assets, I guess.
Oh
yeah. Well, she might, right? And she has a car and stuff, right?
Yeah.
Yeah. That could be a good situation.
Yeah. So like she's doing like some events for like parties, quinceañeras, or like a big thing over there, and she's working as I guess like a contractor for now. Like people kind of just pay her in cash, pay her like in Venmo, whatever, and whichever way they can.
Yeah.
And from that, like,
so can I interrupt you right there?
Yeah.
So assuming she hasn't made any election with the IRS, she's going to be treated as a sole proprietorship. And for legal, like personal asset protection purposes, she's going to be on the hook if there is any liability associated with any of those things, right? So I just wanted to make that clear. So
yeah.
And that's where I think you're saying an LLC might be helpful, because what if something goes wrong?
Yeah.
Is that right?
Yeah. So I honestly thought an LLC would be better for taxes, but what you're making it sound like is it might be better for taxes, but that is like more once like you're more established, it's not the best thing for beginning entrepreneurs. Like they should probably pass like a certain threshold of income before they start thinking about making an LLC. Is that what you're kind of getting
I
at?
would say that, yeah, without like being very specific about advice, I would say that a, there's costs to being an LLC that are non-tax.
Mhm.
There are non-tax costs. And a lot of people rush towards an LLC for various reasons because I think that's like the common knowledge. Where I think that you should also consider the fact that there's other burdens, et cetera, that you have to do.
Mhm.
And I think that that gets overlooked sometimes. And so what ends up happening, and you'll see this, where a lot of people have LLCs, which there's no business activity. And so they'll file a return with the IRS.
This is me.
Is that you? Well, the problem is like someone has to fill that out and that costs money for you.
Yeah.
Right. So there's situations where you're paying a CPA to do all your LLC tax returns. You got five LLCs. None of them have any business activity. You're paying $5,000 a year or something to a CPA to fill out a nothing that's not generating any income for you. So so you need to consider that, right? Do you really need an LLC? A lot of times a sole proprietorship, just doing business on your own, like your mom, setting aside the asset protection from a tax perspective is going to be advantageous in some ways, right? Now, S corps can be advantageous too, but they have huge non-tax costs too. So I think a lot of times, I understand what you're saying about finance bros, but I see the opposite, where I see a lot of people who want to do a business they're not business majors. They want to do a business and they're like, do I need an LLC? Should I get an LLC? How do I get an LLC? How do I be an S corp? Because they just hear these words on wherever they hear them, maybe TikTok. A podcast, I don't know, TED Talk or whatever.
TikTok.
Well, TikTok, exactly. Yeah. No, it really is a lot of TikTok, and so they're like, well, how do I do this? Can you help me, Professor Venkat? And I'm like, look, let's take a step back. How much money are you even making? Because I think what you said is right. If you're not making enough money, I wouldn't give you advice, but I would tell you to consider the fact that it may not even be worth it to file for an LLC, right? So that I think is a major thing, because I've talked to other people about things like this, and they're always like, well, let's talk about LLCs. And I'm like, well, let's even think about if you should have an LLC or an S corp before we even get to that stage. Because when you're in the growth phase, let's say you just started a business today, do you really want to get an LLC? Because what happens in 2 years when you moved on and that's just a dead entity, not making any money, but you're paying somebody to do the taxes, because maybe you have to still do the taxes, right?
Yeah.
So just keep that in mind. That's one piece of information I would provide. Just consider the burdens of filling out forms and paying stuff that has nothing to do with taxes, but because you have a business entity, now you face those costs, basically.
Yeah. And this is making me like a little bit conflicted, because like you're kind of unveiling this, and I'm kind of like looking at this, and I'm like, yeah, I feel like I've created an LLC because I've done different things within the real estate industry. Like I've done leasing, I've done the residential sales. I've at some point tried to do wholesaling, and I saw that there was like a lot of legal liability, and like a lot of like the successful agents were doing, like, they were registered as LLCs, and I was like, oh man, I gotta get one.
Yeah.
But I also wasn't making that much money. I was making like pretty good money for being a student, but not. I don't have enough clients, and I don't have enough what's it called? I don't have enough business to start worrying about like the liability per se. Because right now it's like 67 students that I've helped. I've helped one homeowner, and I've helped another homeowner and another investor kind of close the deal. Other than that, it's not really like the big ones to worry about are the homeowners. The students, I mean, it's their lease. Do they really do they really want to go through like legal recourse if anything bad happens? And
their parents might, though. Who knows?
Yeah, I don't know. But like it's I guess an LLC makes sense from like an asset protection standpoint, and just like making sure like you understand that. But I guess what you're saying is that it should be like a certain threshold that you're making within income before you start actually making start thinking about incorporating an LLC. And I think that's pretty interesting, because it's I feel like the narrative and like the social media narrative is like everyone's starting an LLC. That's like the first step you have to do. It's like what makes like your business dream a reality. And like
your business dream a reality.
No, yeah, it's targeted as that. Like you see platforms that are forming LLC kind of target and advertise like that. So they'll be like, do you have that business that you've been waiting to start? And it's like, if they haven't even started, why would they even create the
That's
LLC?
true. That's true.
Um, so you're like, obviously this is not like financial advice
Yeah.
or legal advice.
Certainly not that.
Yeah.
Yeah.
But like from like if you were giving me personal advice, you would say, Gabe, right now in your part in your earning part of your life, or this part of your life where you're not earning that much income, is it really advantageous? You're like more so saying it's not the most advantageous for you, since like I I mean, I have like a car and like that's it. That's like probably like the biggest asset I have.
Yeah, I think purely from an LLC perspective, I think that I would consider the value of your personal assets. And then,
Mhm.
like you were saying, like what kind of business are you doing? Like, is someone really going to sue you?
Mhm.
And I would consider those before forming an LLC
Mhm.
because there's no issue with you doing business as just an individual. Now,
Mhm.
I think something you were saying would be another factor I would consider, and that's maybe your credibility.
Mhm.
I think there could be an extra level of credibility if you have an LLC. I don't know if that's true,
Mhm.
but I can imagine just the way you're talking about TikTok and stuff.
Mhm.
Maybe people will be like, well, Gabe's not a serious business person
Mhm.
because he doesn't have an LLC. There's no Gabriel LLC.
Yeah.
Therefore, he can't be that serious. Do you see
Yeah.
what I'm saying? So that might be another reason to do it. But I would tell you, look, let's value all those costs somehow. Let's come up with a dollar figure for all of those burdens and et cetera. And then let's look at your personal wealth and let's determine if it's the right course of action for you.
Mhm.
Right. And that has nothing to do with your taxes. That has
Mhm.
nothing to do with your taxes. That's only from a perspective of burdens, filing burdens, maybe some franchise fees, etc., versus the benefits, which are asset protection, really.
Mhm.
Then we get to the whole tax argument, right? So the
Yeah.
tax argument, we could start with that. That's a totally different thing. So
Yeah. So I'm gonna take a look at Cody Sanchez's graph. I copied and pasted it on the Google Doc that I sent you, and for anyone who wants access to this Google Doc, I will publish like a like version of it where it's like public. You could view it, and it has like some of the graphs and things that we're talking about. Just let me know when you have it.
I have it. Yeah.
Okay,
Cool.
so she posted this as a part of her savings breakdown. I saw this on LinkedIn and I was like, "Oh, this is interesting. I should bring it to the podcast episode and talk a little bit more about it." So we have the section of W2, S corp, and sole proprietorship, which is no LLC. And we talk about the different versions of it. So a W2, S corp, and sole proprietorship all have $100,000 in income, and then we talk about the write-offs. And I just want to ask, is this like a viable graph? Is this something that we could look at and be like, oh, these are like some of the benefits that I could see like working?
Yeah. This looks pretty. There's a lot of similar graphs. Like this is a table basically comparing if you make money as a W 2 earner, S Corp,
Mhm.
or sole proprietorship with no associated LLC. And yeah, this is pretty, this reflects a lot of reality. Let me put it that way.
Mhm.
Reflects a lot of reality.
Okay, so what we see is, I'm just gonna point out the basic like sections of it. So it has income write-off, new taxable income, self-employment tax percentage rate, self-employment tax cost, self-employment tax savings, income bracket, income tax cost, income tax savings, total tax cost, and total tax savings. So what I want to say for the total tax savings, so we see a W-2 having $0 in total tax savings. The sole proprietorship has 8,600 total tax savings, and the S corp has 13,000 with $190 in tax
Mm-hmm.
savings. And these these are just some of the numbers that kind of like show this, but this is also like with the idea that you're making 100K at this point. This is not like you just starting out your own LLC. um so
Well,
can
let me say a few things about this if you don't mind.
Yeah, yeah.
So, here I would say the overarching theme of this is, and I'm assuming you'll show them.
Mhm.
Okay. The overarching theme of this is that if you're a W 2 earner somehow in the same business as you could be an S Corp or you could be a sole proprietorship, the overarching theme here would be there's basically no tax write-offs for a W-2 wage earner, right? If you're working for somebody else and you're making 100K, that's going to not result in any business deduction. So you don't have any tax write-offs. I think that's what's going on here. That's why the tax benefits of being a W-2 are zero. So that's the first thing. The second thing is when you compare the S Corp to the sole proprietorship, there's basically an extra tax savings of an S Corp in this, essentially because as an S Corp, you're part employee, part owner. And as an owner, you don't have to pay basically self-employment taxes. And as an employee, you do have to pay some employment taxes. Whereas as a sole proprietorship, it's all subject to self-employment tax. So essentially, sole proprietorship means that for the part of the taxable income of 100K that's attributable to you being an owner, you don't have to pay any self-employment tax. And that means that your overall tax liability is lower. That's why I think I didn't go through it carefully, but that looks to be why there's total tax savings here that are larger for the.
Oh yeah, it is because like sometimes within companies, like I remember you were talking about CEOs. Sometimes they have like a base salary, but most of their income or most of like their wealth building by being a CEO comes from like dividends, distributions, or like stock within the company. And that
S corps are similar.
yeah, and that's like what you're saying. Like here it says that as an S corp, she had a 40K salary and had 30,000 in distributions.
Yes.
So the $30,000 in distributions is what's causing like that extra tax savings.
Yes.
Is that correct?
Exactly. So basically, the S corp, if you start an S corp today, part of your income from the S corp would be because you're an employee of the S corp, and another part would be just like a dividend from a company because you own the company partly. That second thing is what we call distributions. Now, the first thing is subject to the employment taxes, which we talked about before with regards to W-2. So all of that will be subject to employment taxes, and that's 7.5%, 15% total. The distribution part, the owner income, not subject to employment taxes at all. So that means that if you're making money as a S corp, you get to not pay a full. I mean, technically, you don't have to pay a full amount of employment taxes because part of your income is going to be not as an employee; it's going to be as an owner.
Yeah.
Now, if you compare that to the sole proprietorship, basically, I think the point that's going on here is that as a sole proprietorship, there's no distinction between being an owner and an employee. So all of your sole proprietorship income is going to be subject to the employment tax. And that's why it's less tax advantageous with these numbers to be a sole proprietorship compared to an S corp. Because with an S corp, you avoid some of the employment tax. With a sole proprietorship, you have to pay full employment taxes.
Yeah.
That's the big difference. Now, one thing I'll say that's missing here is the QBI deduction. And again, I was telling you beforehand that this has come up. QBI deduction is going to apply to, you should know this, your qualified business income, which is your income that's basically from a business. Now, if you're an S corp and using these numbers, 40K, let's say 40K is your salary, right? And the rest is a distribution, something like that. Is the 40K your qualified business income? No, that's your salary. So only 70K is going to be allowed as a base for the QBI deduction, which means that you're not going to get a big QBI deduction if you're an S corp. If you're a sole proprietorship, you don't have any employment income. It's all basically passed through. It's all business income, which means you get a very large QBI deduction. And the QBI deduction is a huge tax advantage nowadays for small businesses. It's 20% of your business income. You just get that as a deduction. So if you were to do the math,
is that brand new? Like the QBI deduction
after 2017,
okay,
it's basically applicable to most businesses that are not specified services, which are like health, law, accounting. Remember we talked about this a little bit.
It was like just like professional services, like
investment management, but real estate, certainly there's a particular set of rules for real estate QBI deductions. And they essentially say you have to actually be doing stuff in your real estate partnership. It can't be passive. So you have to actually be going to your properties and managing and stuff like that. There's like some hour requirements, but assuming you met those, if you were to do the math after a QBI deduction, which we could do, it'd be interesting to see how much of the benefit of the S corp is actually, it might even be reversed where a sole proprietorship might be better after all of this. Do you see what I'm saying?
Yeah. So how would you evaluate this? You could also edit the doc if you want to.
Yeah, I would say that this is probably a good, and I think you made a really good point, which is that how many people are making gross income of 100K right off the bat? I think that's a good point. But honestly, this stuff should scale pretty much if you're making 10K to 100K. So all of this should work for that. I don't think most of these things would be, there's no phase outs or anything. I would say that the number one thing I would add here is the QBI deduction, because I think that that's going to make the numbers look very, very similar. I'd have to do the math. It's hard to do it in my head. There's some self-employment tax issues, but let me put it to you this way. Taxable income in this example for the sole proprietorship is 70,000. For the S corp, it's basically 30K as a distribution. So 30K times 20% versus 70K times 20%.
So 70,000 times 20% is 14,000.
14,000 versus 6,000.
Yeah.
Is that right?
Yeah. So
the difference right now, so that's an extra tax saving, right? You can, I mean, you have to work it through the brackets, so I don't know how it would work, but that's an extra tax write-off. Let me put it that way, for being a sole proprietorship.
All right.
Of 9K roughly.
So wait, for the S corp, there is no QBI deduction. Is that correct?
There is a QBI deduction, but you got to remember what the QBI deduction is. The QBI deduction is for qualified business income. All right. Now, if you're an S corp, you're an owner of an S corp, you have to pay yourself a reasonable compensation. Reasonable compensation is not business income. It's more or less salary. So the part of your income as a S corp owner that's salary is not included in the base for the QBI. So
bullet point list real quick. What is qualified business income?
It's sort of just income earned from businesses. It's reported on your Schedule C generally, which is basically your income from business sources. So you could be any income that you're earning from a business activity, essentially. So, but it's not income as being an employee. Do you see what I'm saying? So again, going back to the S corp, remember what we said. The reason that, based on the numbers that you have, that an S corp is advantageous to sole proprietorship is because an S corp treats part of your income as compensation for being an employee and part of it as a distribution for being an owner.
Yes.
Right. And that results in less employment tax. That's the numbers here. However, the flip side of that is, because part of that income is employment income and part of it is your ownership income, the whole thing is not eligible for QBI. Only the ownership
partnership.
Yeah. Whereas sole proprietorship, all of it is business income, which unfortunately for you, right, means that you have maybe more self-employment taxes. But the converse of that is you have a bigger QBI deduction. So how the math works out is, depends on the numbers.
Yeah.
But it could be the case that they cancel each other, or at least they make it closer. It might even flip in some cases, right?
Yeah. So I got this from Cody Sanchez. She's one of the people I really like to listen to. She talks about her time and experience within Goldman Sachs. She's a really cool person. If you haven't heard of her, to just check out. She talks about like being a woman in business, having like a cutthroat mentality. She also talked about how she was a journalist at one point, reporting on the cartel, and how she ended up seeing a lot of these like women go missing, and she thought she was making a difference like within journaling, but she realized that she was only bringing awareness. And the true change that came from her was once she started seeing the power of wealth, and real change comes through wealth and comes through power. And she's I think her story is just really interesting. She's like one of the people I actually listen to kind of distinguish like what I'm actually viewing from every financial guru out there. But in this example, she gave a lot of her deductions. So it was everything from home office expenses, operating expenses, travel expenses, employee wages, and she broke down all of her deductions, and you could see it on that. I also remember that at one point you talked about there's different ways. There's like different things for every single person, like to use the tax code to their advantage. But it only comes from like knowing certain things. So an example could be
the QBI deduction.
The QBI deduction.
It's a huge benefit. And I think like you're talking about, I'm pretty sure this probably was before the QBI deduction. But a lot of people wouldn't know about that. And that's 20% off your income, which is a pretty big advantage. So that's a good example.
Yeah.
Yeah.
So So for people who have like a side hustle, they should pay attention to a QBI deduction, and that should be like the. Do you think it should be like the? Let's.
Let's go back. I think that's a good question. I would definitely put that on a checklist of things I was trying to do.
Mhm.
So I would, um, if you have a real estate business, there are certain requirements that you have to meet, and I know this because we were the QBI deduction. Without saying too much about my family situation, we're looking into the QBI deduction for my family's real estate business.
Mhm.
And so I would look into that, especially if you're in real estate or if you're in any business except for an accounting firm or a law firm,
Mm.
you could be eligible for a QBI deduction. And there's some regulations about it, but it's pretty open ended unless you're a professional service entity. So I would say that. The other thing, I would just go back to this distinction between the S corp and the sole proprietorship. The sole proprietorship has literally zero administrative burden. The S corp has huge administrative burdens. So the S corp, it has members. You have to pay yourself a reasonable compensation.
Mhm.
What's reasonable compensation? Well, you remember the words ordinary and necessary. And remember we said we don't even know what ordinary and necessary really is.
Mhm.
It could depend. So that becomes a lot of times what you have to do to figure out how much you have to pay yourself as compensation is you pay a payroll person to do that. So now you're paying a payroll person. That's an extra cost for you, right?
Mhm.
On top of that, there's all these legal requirements for an S corp. Like you can't have too many shareholders, et cetera, et cetera. There's different corporate governance rules. All of that is a headache for many, many people.
Yeah, and most people who are in the S corp have like some person doing that for them.
Yes.
Like a lawyer, CPA.
Yes. That's the point I would really make. So if you're really like you or you're just starting a business, do you really want to pay a lawyer for a business that's not turning a profit or a huge profit
Mhm.
yet? Right. And again, S corp is going to give you that personal liability avoidance issue, but it's probably not worth it to pay 5K a year to a CPA just to do that, right? So
Mhm.
consider those non-tax administrative costs when you're doing an S corp. I think that's a huge deal that people. I think S corps are somehow really sexy right now. And the thing I keep thinking about is, well, there's huge cost to be an S corp in terms of filing requirements and the stuff that we just mentioned that gets overlooked. So I would say when you're thinking about doing this on your own, think about just being a sole proprietorship just to give yourself less of a headache and focus on your business.
Mhm.
And you're going to get a lot of the tax savings. Plus, you get a bigger QBI deduction than an S corp, maybe. And so it might just be worth it from a tax perspective and just an overall non-tax perspective to be an S corp, to be a sole proprietorship. But I would say that the number one thing I would look at is I think she's got a lot of good information here. Employment taxes and the distinction between an S corp and a sole proprietorship is huge.
Mhm.
So I think that that's a good thing that it's very important to note that because it's actually a big number, but I don't think a lot of people notice it. They tend to think about income taxes. And then the second thing would be the QBI deduction for just generally any business.
Mhm.
Now, in terms of these other deductions, I think they're super important. I don't know how much you want to go into these, but we could talk about them.
Um, I think those would be a little bit out of the scope because I feel like these could start being researched a little bit easier.
Well, let me just say one or two things
Okay.
because I think that the home office one the home office one I think is ripe for audit. So remember I said a lot of times the IRS historically used to audit people with big home office deductions. But guess what? That doesn't mean, like you were saying, that doesn't mean that you did anything wrong. That just means that they want all the documentation that yes, this room is actually used for a home office and has to be exclusively used for a home office. There's also a distinction between direct and indirect costs. And all of these costs can be sort of allocated on an individual basis. So let's say you have a home office and it's 20 some percent. You have to look at whether there's what the direct costs associated with it are. And sometimes that could be more than just the square footage because home office deductions, we typically allocate them based on the square footage of the home office relative to the whole property, right?
Mhm.
But there's certain direct costs which you can allocate more to the home office. So like maybe you repaired a window or something like that. That's a window for your home, but you can allocate all of that to your home office. Do you see what I'm saying? So
Mhm.
that generates pretty big deduction. That could generate pretty big deductions for you. I would say that's a big one. And you're right. There's a lot of regulations and detail that you should research. But this is one that a lot of people miss. If you have a business, you should probably have a home office.
Mm.
Do you see what I'm saying? And this area that we're in right now looks like a home office to me.
And does
Maybe get rid
that
of the TV, but beyond that,
yeah, does that work for sole proprietorships or do you have to have an LLC?
you don't need an LLC. You can do it through your sole proprietorship.
Yeah.
That's exactly right.
You can do it through a W-2. Is that correct?
You can do it through a W-2, but the deduction is less advantageous. So basically, assuming you only have W-2 income. So let's say you don't have a business, right, of any kind. But let's say you
Work from home.
work from home. Let's say I'm a professor. I do some UT work from home. There's some sort of like home office benefits to that, but it's not huge. It's itemized and most people don't take it. So for W-2, you're not getting that, more or less.
What does that mean? Does that mean that you get like a bigger refund? Does that mean that
If you have a big deduction,
yeah, like let's say you take a deduction for your W-2, like for the home office.
that's a little bit more. I wouldn't ever think that happens, but basically you can reimburse certain expenses associated with your business. I mean, with your profession. Let me put it that way. So I've never seen like people really take a home office deduction for being like a normal W-2 wage earner. Usually you have a business. Usually you have a sole proprietorship or an LLC with S corp taxation, whatever it is. You have a business, and that's when you get the home office deduction usually. So for a W-2 wage earner who's like working from home, a lot of times you're not going to get any benefits of that. There's not going to be any clear tax deduction that you get for that. You could try to squeeze it into other stuff, but I'm not sure if that actually works. That's
but
open-ended.
Like they don't have. Well, I know technically like a W-2 person does have like a tax bill, but they're not paying it.
The W-2 wage earner?
Yeah, like they're not paying it out of pockets. They're not like at the end of the year saying,
"Oh, yeah, they will pay. They could pay a little bit. It depends on how much you withheld. So you are definitely going to owe taxes at the end of the year, but with your withholdings, you may have paid what you owe already, right? So typically what that means is if let's say you do your tax return at the end of the year and the amount that the IRS that your employer has withheld from your paycheck for your income taxes exceeds the amount that you calculated on your tax return, then you're going to get a refund. So if, let's say you weren't planning on taking some sort of deduction. I'm not going to use a home office deduction because I don't think W-2 people really do that. But let's say another deduction. Let's say you got a deduction and you realize, oh, I could actually get this deduction somehow. Maybe a big charitable.
Let's do a travel nurse, or no, not a travel nurse, because let's do mileage. I think most people travel to work.
Travel expenses?
Yeah.
Yeah. A lot of that is a lot easier to do with a business. So I think if you're a W-2 wage earner, Cody Sanchez here, you're not getting many tax deductions for going to work, your travel expenses, etc. If you have a business, then you could say that part of that car is business use. Now, by the way, that's historically been one of the things that's audited. If you have a business and you have a car and you're trying to take a huge mileage deduction, basically arguing that a car that you use both for personal and business use, you're somehow using a lot of it for business, even though really you might be using it for personal, you need that very well documented because they will look very carefully at that. So a lot of times the stuff with the W-2, like I think Cody Sanchez here says no tax deductions, right? And I think that that's arguably true. It's hard to get tax deductions for business expenses unless you're really doing a separate business. But if you're working for somebody and let's say you're driving, there can be some deductions for that, but not really.
Yeah.
Actually, I would say not at all, to be honest. There might be some itemized, but usually you get deductions based on mileage for a business use car. Now there are certain things like I've seen situations where if you're using like a work car, you can sometimes try to deduct part of it, but I don't, that's not a common thing. That's not the best way to maximize your taxes. Let me put it that way.
So my question is more so along the lines of, we have all these things that you could do for being a 1099,
Yeah.
sole proprietor.
Oh, I see.
What
can you do for W-2?
What can you do for W-2?
Oh, I see. For W-2, the best thing is to start a business. If you can, I guess, like, so let's say you're working as a traveler.
Does that need to be LLC or no?
No. If you're a W-2 wage earner, the reality is you probably don't have access to that many tax benefits. And I think that just looking at your thing here, Cody Sanchez put somewhere that the best tax deal in America is owning a small business. And that's probably right. And I think the implicit point she's making is working for somebody else is not a tax deal. It's generally not the most attractive thing in the world. Why is that? Because you don't get that many deductions. Business deductions are going to be a huge source of tax breaks for people. And if you're a W-2 wage earner, unless you have a side hustle or side business, you're really not getting that many deductions. So just to give you an example. Like in the 80s, right? We had a bunch of lawyers and doctors who were making a ton of money. And so what they used to do, this might be related to stuff you do, is they would actually buy, there was all these big companies like your large banks and accounting firms, they would sell tax shelters. And essentially what they were you'd have a doctor buy into a real estate partnership that was losing money. But it wasn't really losing money, but on paper, it was generating tax losses. Now, why did they want to do that? Well, because the tax rates at the time were like 60, 70%. So this doctor is going to pay on their last couple dollars of income, 70% of that in taxes. They're like, how do I reduce this? Their effective tax rate could be 50%, right? 50% of their income is going to the feds. So they actually started selling these things. You'd buy a partnership and get a loss, just like you get a loss deduction and take that bill down. Now they crack down on those, and there's all kinds of rules now with passive loss rules. You probably know about those if you're in real estate. But there's always there's an industry out there, cottage industry, that's basically trying to sell tax shelters to wage earners, because wage earners, especially doctors, lawyers, whoever, bankers, they have a lot of W-2 wages and they don't get any deductions. So they try to find a way to generate business deductions. And so that's really important. The best way to generate deductions is through business deductions. You see what I'm saying? The other things you could do, I mean, there's all kinds of tax favored retirement plans, et cetera.
Sorry, before you move on, I want to say, because you said the best thing to do is to start a side business, but these are two separate things. We have a W-2 and then we have like someone starting a 1099.
Yeah.
Are these at the end of the day combined to the IRS, or are they treated as separate things and then now you have to deduct separately from the 1099?
That's a great question. And it's a fundamental thing that I just skipped through. But basically, at the end of the day, for your personal taxes, you're going to combine your income from business and your W-2. So if you have a loss from your business, that could potentially offset your W-2. And so that's why we had these lawyers and doctors buying into real estate partnerships that were giving them tax losses, because their W-2 wages from being a lawyer are like $700,000. But now that real estate partnership is giving them a $200,000 business loss deduction. And so they get to reduce their taxable income that way.
Yeah.
Does that make sense?
Yeah. So start a business. So the to do for a W-2 would be start a business to claim losses.
No, I mean, you can't really do that.
Yeah.
You can't really do that. I wouldn't even say that that's hard to do nowadays. I think if you want to reduce your tax bill as a W-2 wage
That was
earner,
a joke.
That was a joke. I think if you want to reduce your taxes, it's really, in terms of a completely legal thing, you could try to look at, let me put it to you this way. And I think this is really important, actually. I mean, I have a lot to say and it's not very organized, so I apologize, but it's not a tax minimization strategy to spend money, right? Because theoretically you can make a charitable contribution deduction. But guess what? Now you paid someone money. You gave the charity your cash. So if you save taxes by giving someone else your cash, is that really optimal, right? So real estate people will always say this, but like depreciation is a real tax shelter, because depreciation, you're not spending cash, but you're getting a tax break, right?
Yes.
And so I think that that's a huge distinction to make. As a W-2 wage earner, a lot of what you can get a deduction for, and you're not even going to get a very big deduction, but you could potentially get a deduction for, is going to be things that you actually spend money on. And is that a tax break? I'll tell you, the best way to not pay taxes is to not make money, right? So if you want to, pay a ton of money to charities and all this other stuff and then not pay taxes that way, well, you don't have any cash left over personally at the end of the year anyways. And that's the thing about being a W-2 wage earner. There's a few tax deductions that have nothing to do with cash flows, and one of them is depreciation, right? So bonus depreciation is a huge tax advantage.
Yes.
Right?
Oh, yes. That is one of the things I did want to talk about. I wrote it down and I was meaning to get back to it. But depreciation versus deductions, I wanted to talk a little bit more about that and the different parts of it. So deductions and depreciation could get pretty confusing at times, and a lot of people just don't know how to go about them. So I know with depreciation, there's a lot of rules. There's makers for some. There's 7 years, there's 10 years, there's 30 years. There's a lot of numbers being thrown around and a lot of rules being thrown around for it.
Right.
if you were to try to describe it to some high school kid who doesn't even know like what an asset is, what would you tell him?
From a tax perspective, I would say it's basically a tax break
Mhm.
for owning an asset,
And
for owning something
it's a
in your
tax
business.
break not just for this year, but for the next 7 to 10 to whatever your
Yeah,
asset is, right?
in some cases, yeah, it could be for 7 years. It could be that you just get a huge deduction up front, which
Mhm.
is awesome. You prefer that, right? So
Yeah.
I would say depreciation deductions are a tax break for just owning an asset
Mhm.
in for tax purposes. So
And deductions are tax breaks, but just for the year.
they could be for more than they could be, yeah, they're basically going to be deductions in the current year. So we
Mhm.
typically talk about in a current year. But let me just put some flesh on this real quick. So the reason I'm sort of not totally agreeing with you is that you could have bonus depreciation.
Mhm.
And that would be a deduction. We didn't think about bonus depreciation. You might get a car in your business. Let's say you get a computer in your business, and let's say it's a 5 year asset.
Mhm.
You'd get deductions for 5 years based on the value of the computer when you bought it, right? But with bonus, you get 100% or 80% upfront. So you get a huge tax deduction in 1 year, and then you may not get too much after that, right?
Mm.
Remember when we had 100% bonus depreciation, if you bought a computer, the cost of that computer to you was immediately depreciated upfront in your business. That was just one deduction. You don't have anything else to depreciate for the next 4 years because you deducted all of it upfront. So that's a huge tax. That's a huge tax benefit. Why is that? Because there's really a lot of times you may be paid for it up front. That's your cost there. But you could have situations where your depreciation is very large. Maybe it exceeds that your cost or the fair value of whatever you're doing, and you don't have the associated outgoing cash flows, especially if it's over 7 years or 5 years.
Mhm.
You paid up front for something, maybe you financed it. A lot of times they get financed, right? But you still get to depreciate it. So you could buy an asset with financing. Yeah, you have to pay interest and you have to pay back some of the principal, but you get a tax deduction for depreciation, even though you don't technically own the asset. So your
Mhm.
cash flows are going to be pretty cool. You're going to get a tax break and you didn't actually pay for the full amount of the asset, right? And you also could get other deductions too.
Mm.
So I think that that's really important.
So that works a lot with like real estate, and that's why real estate is like the big thing because people, let's say, pay $10,000 or some arbitrary number as a down payment,
Yeah.
and then from
Yes.
there they finance it,
Yes.
and then they have this big value of their property. From
Yes.
there, they're able to take the uh, a depreciation expense each year to minimize how much money they actually made throughout their throughout their throughout the year.
Yeah. And they're going to get another deduction because they financed it.
Mm.
Interest.
So I before we go into bonus depreciation, I kind of want to go a little bit more into depreciation and what it actually is. And then I want to add bonus depreciation. So um there's this word, I'm blanking on it right now, but I think it's called accelerated depreciation. Is
Mhm.
that essentially what bonus depreciation is?
Yeah, it's super accelerated depreciation.
Okay.
Yeah, it's super accelerated depreciation.
So instead of like taking the all the small expenses over 1 to 2 to 1 to 5 to or 5 to 7 years or even
Yes.
30 years or even 35 years, depending on if
Yeah.
it's like a commercial building or something, it could be then taken in one big year.
For buildings, it's generally not applicable,
Yeah.
bonus depreciation. But for like certain fixtures in real estate, a
Mhm.
lot of times, like in your house that are detachable and movable, those things are subject to bonus depreciation.
Mhm.
So let me just say depreciation refers to essentially a cost in a business for wear and tear. When
Mhm.
you use something, it becomes worn down. After a couple of years, it's not worth what it was before. So
Yeah.
that's typically what we call depreciation expense.
So it's like if you buy a new computer, at some point it's going to become obsolete, and depreciation is essentially helping you deduct that obsoleteness.
Exactly. So it's sort of this idea that in reality, you get a new phone, right? After like a couple of years, you realize it's slower. It's somehow not as good with the new operating systems.
Mhm.
That's all depreciation. It's wear and tear. Basically, this thing isn't as useful as it was when I first got it.
Mhm.
And the tax code gives you a deduction for that thing, that depreciation thing. For things like phones or computers, they have to be used in your business. That's clear. So it's not W-2. It's got to be used in your business. You can get a deduction for those things, and the IRS gives you a specific amount. All of those specific amounts are what we call accelerated depreciation, because essentially what they do is they give you big deductions up front and it becomes smaller later on. So for the first few years that you own the asset in your business, you get a big deduction. And then towards the end, let's say 5, 6, 7 years, the deduction gets quite small. Okay. Bonus depreciation flips that on its, it takes that to the extreme by essentially saying you get to deduct the full cost of it up front and zero later. So typically with depreciation, you're taking a little bit every year. This just says deduct it all in 1 year. So the year that you buy something, you get a huge tax break.
So this is what you were saying whenever you were talking about big corporations getting zero tax bills. These are all the headlines that everyone's seeing.
To some degree, a lot of times it is things like bonus depreciation, but it can be a little bit more aggressive, like the use of international tax shelters.
Yeah.
That happens a lot too. You shouldn't. Corporations, sometimes it's hard to tell because we look at one number, they paid zero taxes. Sometimes it's totally legitimate. Bonus depreciation is totally legitimate. It's encouraged by the tax code. International tax shelters are not.
Yeah.
Right. So you can't really distinguish when you see Amazon paid $0 in taxes, why they paid it. Was it some aggressive international tax shelter with the best lawyers? Or was it something like bonus depreciation, which you and I would be able to get with a business, right? So I think that that's an important distinction. The large corporations don't pay taxes because of both. Because they have, the important thing is they have the sophistication to put together aggressive international tax shelter plans. They have lawyers and accountants, but they also have lawyers and accountants to take the benefits of the tax code that are obvious, that are not illegal, not aggressive, but are there for the taking, basically.
Yeah.
Yeah.
So as we start wrapping up pretty soon, I want to do a ranked to-do list for each person. I want to do a ranked to-do list for a W-2 earner, a 1099 earner, or someone in an LLC. Let's do S Corp to make it simple. What would be like the big things that you would have someone do from?
So I think this is something that I didn't say, but we should make it very clear. For the W-2 wage earner, the number one thing I would say is to think about your withholdings, your income tax withholdings. There could be other things. And again, that's just what I would do. That's what I do because I do get a W-2 wage. So I don't necessarily, people should just use whatever information they have. But for me, the number one thing I consider is what's my withholdings? And the reason that's important is because I don't want a big refund. A lot of people think you want a big refund. You don't want a big refund. That is generally speaking, a bad thing. Okay. You don't want a big refund because it basically means you overpaid the IRS throughout the year. Right. So we're talking about withholdings. It basically means that you paid too much withholdings to the IRS and you didn't actually owe that much. So then they're going to send you a check for the difference. We don't want that. So what I typically do is I try to look at how much were my withholdings and is it going to be much different from last year to this year? Now there's a range that you have to be in. So you can't just withhold nothing. You have to essentially make sure that your withholdings are something like 90% of your current tax liability or 100% of last year's. But a lot of times what I see is people continually withholding too much. So let's say that you paid taxes of $20,000 last year. This year, your withholdings can be $20,000, right? It can be $20,000 and you wouldn't have any penalties. A lot of times what you see is people are withholding because maybe their salary went up. They'll withhold like $25,000. But legally, you don't have to have that extra
withholdings.
Yeah, that $5,000 necessarily. It's got to be, there's a certain set of requirements, but typically you don't have to withhold that extra $5,000.
Okay.
So I would just take a look very closely at my withholdings. I don't want to give an interest-free loan to the government.
Okay.
With that said, there's some risk associated with that. So let me just say that. So I'm not telling people to do this. You have to make sure you're not going to run afoul of, you need to be within a close approximation of your liability. And it also depends on your taxable income number. But I would take a look at your withholdings. That's really all you could do as a W-2 wage earner. And I don't know if there's any other deductions. I could be missing something. I'm not a W-2 wage earner expert or anything. There could be other deductions that people get, but as a W-2 wage earner myself, I look at my withholdings because I don't want it. That's the biggest tax advantage I think of.
Okay. And essentially, what you're saying is that instead of them getting a big uh, refund at the end, they would have a little bit more money at the end of the month. With
Yes, exactly. That's the
okay.
best way to think about it. So I want a little bit of money every month rather than getting a big check from the IRS with a huge refund at the end of the year. Because I want the money now, not at the end of the year, right?
Okay. So, is there anything else that you would recommend for W two earners to just like think about and to do?
For W-2 earners, I mean, there's decisions, very personal decisions. In terms of me, I'll just say that like looking into getting married versus not, there's
Hmm.
different brackets and different what we call marriage penalties kind of diminished, but there's a marriage penalty associated with certain things. I guess there's some tax. I would say maximize any. Uh, it's always good to maximize like your 401ks and stuff. Those are usually tax advantaged or tax like Roth IRAs, things like that. If you have access to those, which you could have a whole podcast on that probably.
Yeah.
Retirement plans that are tax advantaged are usually going to be a good thing, especially if employer provided retirement plans are usually tax advantaged. Basically, what I mean by tax advantaged is you don't have to pay taxes on them sometimes, either upfront or after you withdraw the money. So that's typically what I do. I try to maximize those accounts. And most people take what we call the standard deduction. So all of the things related to charitable and all that, it's not a huge benefit, to be honest. So it's kind of funny because everyone knows about the charitable contribution deduction, but really, especially after 2017, there's far fewer people that can actually take it. It's really just really wealthy taxpayers who do charity.
So, I remember the other thing being start a business for W two. Is that because I just want to clarify this? Is that because the W two would then have more wealth built, and then then that extra wealth that is built aside from their, let's say, 100K salary. Let's say they made 50K, so now they have like 150K, and that 50K would then be like that split difference between 150K that you made in total income versus your W2, that 50,000 is a little bit, or not a little bit, but you could just have more tax advantages with that extra income? Or why would you recommend starting a business?
Yeah, I don't necessarily. I mean, I think I said that jokingly. Like, I
Okay.
don't. If you can start a like, so you got to think about what a W-2 earner is. So I'm a W-2 earner with the University of Texas. They pay me to teach, right? Can I start a business with that? There's no possible. I'd have to start a separate business, right? Now, let's say that you're a W-2 wage earner in the sense of you work for somebody else's real estate company. Well, you could always start your own real estate company and do a business that way, right? So it's not easy to just start a business depending on how you're earning your W-2, right? So I know that as a professor, for example, there are certain engagements that they'll pay me to go give a speech or whatever, some sort of thing. In that situation, I can start a business for that kind of money. But for my W-2, I can't collect my W-2 I'm not going to collect it through an LLC. So in theory, you might be able to, but I don't know. Most W-2 wage earners, you'd have to start a separate business and not earn a W-2 anymore. Does that make sense? Or you could start a side hustle. And to the extent that that generates business income and business losses, then it's going to be tax advantaged, right? But most people who work for a big company, there's no opportunity to like somehow convert that into like, I get a W-2. You can't just start an LLC and then receive the W-2 through the LLC and pay less taxes that way or anything like that. It's a lot harder.
I remember there was this part in the 4 hour work week where some people negotiated from being a W2 person to a 1099.
Yeah.
Within their like employment. Would that be in a sense something for people to think about?
Yeah, that's it depends on the job again, right? So I can't go to the University of Texas and be like, I want to be an independent contractor. But if you're, I don't know, maybe like you mentioned travel nurses before or other people who can be contracted out, your employer might prefer that in some ways. And yeah, it might be beneficial to you because then you can get tax deductions for your cars and stuff like that. Then if you can convert to being an independent contractor, that's great. but it depends on the business. It depends on the job you're doing. It's not
Okay.
necessarily for everybody.
Okay. So for everyone, I'm gonna be making a ranked to-do list from most important to least important um, for this episode, and I'll post everything online or maybe on a Google Doc or something that everyone will have. All right, so now let's do a ranked to-do list for 1099. Number one and most important thing, I feel like you're gonna say QBI deduction, but am I wrong?
For a pure 1099, I'm a I wouldn't necessarily give any. It's sort of hard to say about these things because there's a difference between tax compliance and taking advantage of tax deductions. And I think with 1099, self-employment taxes and employment taxes can be a little bit complicated. So I would make sure that they're complying with that. That's a big deal because you don't want to be running afoul of the IRS because you missed employment tax payment. So sometimes when you're 1099, they don't, if the person you're contracted with isn't withholding any employment taxes for you, you need to do it yourself. That can be a little bit tricky. I guess like big picture, I would say be careful with your employment taxes. That's the best way I could describe that. Let me see. For a 1099, yeah, other business deductions you can get would be totally fine, right? Like essentially, if you're just a sole proprietorship, what business deductions you can get? I would say QBI. I think that's probably a beneficial one. Home office.
Is 1099 separate from sole proprietorship? Like,
1099 is how you're receiving the income.
yeah.
Right. So,
Wouldn't a sole proprietor sometimes have 1099s?
yes, essentially. Okay. So I guess I would say like home office would be another one if you can like look into that a little bit. Yeah, I think that would be maybe, to be honest, like I don't know if this is in yours, but did she put in like the travel expenses? Yeah, travel expenses are another one that people typically do, to be honest. There's rules about travel expenses where you can almost take a tax break for a vacation almost.
Mm-hmm. Yes, I know. It's you have to be doing business for the majority part of your trip.
And it has to be sandwiched, I think, right?
Yeah. It's something funky. Tax-free wealth has like a lot of like interesting ways. Like if you go to seminars, you could consider those like continuing education.
Usually what people do. On a Friday, you go to a seminar, and then on a Monday, you go to a seminar, like let's say a real estate seminar, and then you travel on like Thursday and Tuesday or something like that. And so travel days are considered work days. So now four of the 6 days you spent there are work days, and 2 are vacation. And because you sandwiched the work with personal in between, you can deduct the whole thing, like including you can't deduct your personal meals, but you can deduct like your hotel expenses and flights and stuff like that.
Yeah, I remember you said something along the lines of business meals are now 50% because IRS does not want the pain of auditing them.
Yeah, they really don't like to. There's a lot of stuff like that. It's just more convenient for them.
Yeah. Okay, so travel expenses, take a look at some of the deductions. The deductions are great at tax-free wealth. A little bit more on who Tom Wheelwright is. He is one of the consultants to Robert Kiyosaki, or Rich Dad Poor Dad. And he was a part of the Rich Dad company, and he does a lot of like tax planning. He's a University of Arizona professor who teaches courses on taxes and just talks about taxes in general. But so we have the deductions, home offices, and take a look at tax-free wealth for different deductions. And
is that what were we saying about that? Is that 1099?
Yeah, this is 1099. The to-do list for 10.
Okay, just to be clear though, 1099 is just a sole proprietorship, right?
Yeah.
I mean, you can elect out of that, but 1099 is just you're getting business income. I just want to be clear about that. Okay.
Yeah.
There's not a difference between a 1099 and a sole proprietorship.
There isn't, or there's
not.
Okay.
1099 is just a form that you're getting money off of, and you're saying you're an independent contractor, and basically it's going to be business income for you. Now, like I said before, if you don't make any election, you're a sole proprietorship. So if you're getting 1099, you didn't elect out of anything, which 99% of people won't. You're just a sole proprietorship.
Mhm.
So I
Okay.
just want to be clear about that.
So learn to comply, deductions. Would you include QBI as a part of this too?
Yeah, it depends on your business, but yeah, certainly. I think that's a good thing to look at.
We'll put QBI here.
Yeah, I think a lot of things is just it's hard to be very specific, right? I think that if I were doing a business, I would look for resources on all these things and just see like, can I get that? Do you see what I'm saying? So I guess this is a way to inform people about stuff they may not know about, rather than to say like you can definitely get this, because I really that's more of a specific legal advice question. I don't know. It depends on your situation.
Okay. Is there anything else other than deductions, QBI, maybe even depreciation? Would you
Yeah, it depends on your business. If it's like asset intensive,
are these depreciated?
yes, these
Okay.
are
I
depreciations.
could depreciate the lights, I guess.
You can depreciate the lights. What year did you get them?
This year.
Okay, so you get like 80% of the cost deducted right away. You could also probably get a QBI deduction. Should probably look into that. We don't want to talk about your taxes on here, do we?
I don't care.
But okay, yeah, you could probably get that. It might be a good idea to think about your situation, just so we could like really have some facts. But I think these are things you could definitely depreciate.
Yeah. So we have a camera that costs 800, light fixtures that cost like roughly 120. These mics cost 150. The stands cost like I'd say probably like 60. And the lights, computer, docking stations, all that fun jazz. It's probably close to
Like $2,000, 1,500.
1,500 to $2,000. So you would say around, just in general, like, I know it doesn't have to be a specific range because like each one of these have like different depreciation rules, I'm pretty sure.
Yeah, that's true.
But if you were to like say a range, like let's say it's like 2,000, I would be able to deduct like 70-ish%, 60-ish%.
Honestly, my best, all of this stuff would be eligible for bonus depreciation from what I can tell, which means that you could deduct 80% of it up front. And
then 20% next year.
Well, yeah, 20%. You could do the next 4 years with makers. There's also the 179 deduction for you, which is similar to bonus depreciation, but remember it's for small businesses. So you could deduct essentially, I think the way it would work is in your situation, all of this would be deductible under 179 and you wouldn't have to bonus depreciate anything. So you could basically write off all of the cost of this from a tax perspective.
But it's either or. You can't claim both.
You could do both.
Oh, you could do both?
You could do both.
What?
Yeah. So you could do both, but most small businesses, the limitations for Section 179 are like in the millions. So unless you're buying millions of dollars of this kind of stuff, you're always just going to be able to deduct most of it with 179. And that's for small businesses. So I would say 179 write-offs are very valuable.
That is very interesting. So like if I was to deduct like $2,000 with just 179, I'd also be able to depreciate it. Like let's say I wasn't even taking bonus. I was just
I see. No, you're right. Yeah, you can't. Once you've deducted it once, you can't depreciate it again.
Okay.
Yeah, you can't depreciate it again. I thought you were saying, would I be able to, if I use 179 on one asset, can I use bonus on anything left? But no, yeah, you depreciate the entire cost of them with 179 for the most part.
Oh,
I
okay.
would guess. If I were to guess, I'm not 100% sure, but all of this stuff is eligible for 179 and bonus. So to the extent you had any amount that wasn't depreciated right away with 179, you could bonus depreciate it.
Okay.
But I don't think that you would be in that position. It'd be hard. Yeah.
Okay. So Section 179, look if look into it, tell whoever is helping you with your taxes if any of your things qualify. And then
if you're getting someone to do your taxes for you, then maybe they would know that. Hopefully.
I don't think so.
Really? Okay. Well then
I think some of those places in like border towns where like,
oh yeah, that's true.
They don't like they have to talk to CPAs
from
like the offices, and like they just do like the bare minimum.
We should do a podcast about that. That's terrible, man.
Yeah.
Oh, geez.
Yeah.
Another thing for you, this could be a home office.
That yeah, I was planning on deducting it.
Okay, just make sure you don't do anything else in here.
Yeah.
Yeah, but and the biggest thing, documentation. All of this has to be very clearly documented. I
Mhm.
think there's too many times where you run to take a deduction without documentation.
So what is documentation? Like I know a lot of people like hear about documenting. What what does documentation actually look like? I know it's receipts.
Receipts with some level of, I think there's usually some guidance about what is needed to be on the receipt. So I forget the actual details, but most receipts will qualify, but it'll be like date of purchase,
Mhm.
amount that you spent, stuff like that. For home offices, it's usually there has to be some evidence that you're not doing anything else in here, so you don't want too many like other things in the room just in case they audit you. Like, so
Mhm.
if you have video games in there, they might be like, what's going on here?
Mhm.
Um, Receipts are going to be the big one that people keep track of. Any sort of evidence of,
IRS agents actually come to your home.
no, I mean they might ask you for evidence. They might
Mm.
they might say like,
So take the TV out of the room once.
well,
I'm just kidding.
that's actually okay. But I was looking at the workout bands over there, and I was thinking like that might be more of an issue.
Yeah.
But I think like things like any sort of evidence you have, it sort of depends on the deduction you're taking. So I know if
Mm.
you're trying to like we're talking about deducting your vacation,
Mm.
you need evidence that you registered for the seminar and like you attended the seminar stuff.
Mm.
I mean, you don't need it, but that's what's advisable because just in case. And you want all that documentation for your own purposes, but
Mm.
yeah, you want to show that if there's like a business meal that you're doing, you want to make sure that it's clearly indicated on the receipt that it's a business meal, who it was
Mm.
with. If you can have it in like your planner or something,
Mm.
meal with business partner, that's kind of the kind of thing that you would definitely want. The more documentation, the better. I think that there's certain, if you talk to a real CPA, they'll tell you like these are the certain things that you should have for every. This will suffice, but it varies depending on the deduction.
Mm.
It depends on what you're doing. So yeah, but document everything.
Okay.
Yeah. And I
Okay.
think one thing I would say about QBI too, documentation is really important in real estate with QBI,
Mhm.
because if you want a QBI deduction for a real estate business, you actually have to show that you're actively involved in it. And so you want to keep track of hours and stuff like that if you can.
Okay. Photos. Document hours. Okay.
If possible, yeah. The more the better. That's
Okay. What are the to-do lists for S corps? What would be like the main things that people
everything
would
that
do?
we just said, but then I would also say really consider the, I mean, are you already an S corp? Is that
No.
the plan? If you're not an S corp already, I would say seriously consider if you're ready to bear the administrative burden of an S
Mhm.
corp. And so like the requirements are, let me just look at what some of the things are, but it's not just one form that you're done for the whole year. It's sort of there's a lot of different things that you have to do. So your first thing is just to like point out some stuff that I just googled. Um, you would need to pay yourself a reasonable wage, which that needs to be, they'll tell you what unreasonable is, but you kind of need to figure it out. And a lot of people just go through like payroll companies to estimate that.
Mhm.
So there's a lot of complexity about S corps that I think are not very well understood. And I would
Mhm.
say like consider all the requirements of being an S corp. I'm trying to think like what's a resource where you could look at it. Honestly, if you look at, I guess like a, if you look at what the S corps have to file with the IRS, you'll see like what kind of complexity there is. But
Mhm.
it's not a simple matter. So I would say that's the number one thing. And then if you're an LLC, if you're an S corp already, do all those deductions that we just talked about.
Mhm.
But I think S corp, I guess if I were to say something, not to like pour water on it on S corps, is that they're actually really a painful process. They can be a painful process for especially
Mhm.
small business owners and stuff who aren't very tax literate. I would say they're not
Mhm.
necessarily like you're good. You got to pay someone to do it, and even that I've had issues personally, family business, with CPA screwing up some stuff with our S corp, and we had to deal with the IRS for that.
Mhm.
So it's not necessarily a simple, and maybe that's why I'm so negative about it, but it's not necessarily a simple thing where sole proprietorships are totally simple. So
Mhm.
consider the administrative burdens and then take all those deductions would be, look into those deductions would be my, if I had a personal checklist, that's sort of what I would do.
Okay. Like the requirements. Okay. And so you would say everything else, consider if you're really doing it. look at the requirements such as like the reasonable wages, CPA costs, and just any maintenance overall. And then let's do two to three actual to dos if they're already an S corp, like other than the ones already mentioned.
Then I think hitting those deductions would be good.
Huh?
I think hitting those deductions would be
The
very good.
QBI and 179.
Yeah, if you're not taking those, to be honest, like once I don't know too many people who have very small business S corps. So the S corps that I'm thinking of usually pay a CPA.
Okay.
And so if you're paying a CPA, then you don't need to worry too much about these deductions, right? With that said, like you mentioned, it might be advisable to take a look at what your CPA is doing and see if they're providing these deductions. And if they're not, then maybe suggesting them and having the documentation to proceed with them.
Yeah.
I think if you're already in business, the best thing to do is to find a good CPA and worry about making more revenue rather than your taxes. Does that make sense?
Yeah.
If you're making good enough money, I guess.
Let's see. Worry about revenue more. Get a CPA. Yeah, because this is like a lot. This could be a lot, and this is very administrative, and it's more burdensome to think about. A lot of people don't want to think about taxes, but like there's a lot of talks about an LLC and like whether you should start one. I also came into this podcast episode thinking that it's best to start one, but now I'm under the impression that it has a lot of maintenance. It has like a lot of like issues with it. It has like
There's nuance.
there is a lot of nuance that people don't talk about.
Yeah.
And
That's the biggest. I would say if I left you with something, I would leave you with that.
yeah,
It's not just a matter of TikTok said LLC, so let's do an LLC. And I think just because you have an LLC doesn't mean you can deduct everything, right? All that stuff needs to be documented very well, and the rules are. So yeah, I think what you're saying is 100% correct. 100%
Yeah.
correct. Again, I'm not trying to say LLCs are a bad idea. I'm saying you need to think about your situation. Do you really need an LLC?
yeah,
Because you were kind of just mentioning before, like I have an LLC that's not making any money, but you have to pay someone to file the taxes for it because you do need to file a tax return even if it's not making money, and so that's just a cost for you.
yeah, yeah. The LLC that I did, it actually helped me out in one thing. I got into a crash, and my insurance bill went up for liability alone, like $360. So I transferred my car to the LLC, and I got business insurance quotes, and I lowered my insurance bill. It's structured differently, but now it's like $88. So I save like $300 a month by doing that. So for me, it's like paying for itself currently, but it was a pain in the butt whenever I like if I didn't have that car expense, I would seriously rethink not having an LLC at all.
Yeah, and I would say it's also it's a smaller level, but I think like commingling assets and transferring assets can be big red flags too. So you got to be careful that it's not your situation, but when you have a business, here's another thing I would say for the S corp. Maybe if you're in business or if you're going into it, there has to be a very clear distinction. We've talked about this: your business and your personal funds, right? You really need to make sure that they're separate.
Oh yes, commingling.
Yes, commingling. That's very dangerous.
Commingling is just like mixing personal funds and business funds together.
You need two different checking accounts, like two different bank accounts, ideally.
Yep.
As soon as they get commingled, there's a chance that all of the S corp limited liability stuff goes away, and so you really don't. That's the whole LLC too, by the way. So that's the whole reason you need to keep them very separate. So
Yeah.
keep it. Ideally, you want a separate checking account.
Yeah.
Ideally.
Yeah. Yeah. I think for me, I just need to like look at my deductions a little bit better, like make sure that I'm spending in the right parts, or like spending, because I have like 8 bank accounts, and like I kind of have them. I kind of have like this like system already all planned out.
Okay.
I'm dropping an episode on like how all of that works and how it's like saved me a lot of stress, and just like makes me think about money less, which I think is like the big thing that a lot of people want. They want their money to do well and then think about it less, just in general. Just for like the average like person who's not like super business oriented.
Yeah, that's true.
But okay, so this is a ranked to-do list. It's for W-2, it's think about withholdings, look to get married, the different deductions, babies, all that fun jazz. The tax advantage IRAs, look into them a bit more. Get a baby for tax deductions.
Yeah, tax credit, yeah.
That's funny. It's very finance, bro. Take a look at your standard deductions, W-2s, and actually, I'm gonna cross these out. Looks like I didn't finish that note. And the rank to-do list for 1099s or sole proprietors is learn to comply with employment taxes and be careful with this. This is where people get in trouble. Deductions, you can think about home office, travel expenses, and resources at tax-free wealth. QBI, look to see if you qualify. Section 179, look into that as well. And S Corps, consider if you're actually wanting the requirements associated with it, QBIs and Section 179 for it as well. And worrying about revenue more than taxes.
Yeah, and final thing, any business income documentation.
Yeah. And documents.
For anyone taking deductions.
Okay, awesome. And if you were to leave just anyone watching this with a little tidbit of advice, regardless of their scenario, any resources that you might want to plug in, or anything that you always recommend to people kind of wanting to learn a little bit more about this?
Wanting to learn a little bit more about this. I think that what I would say, I would say that there's a reason people make a lot of money as CPAs and lawyers. So I would be very cautious about doing anything that you don't know too much about. So I'd say make sure you find a good CPA. I think that's invaluable. I think having a CPA that you can trust, who's going to take, like you were saying, like some of them aren't good. And I've had that experience too, where I'm like, I don't know how to find a right CPA, but once you've found one, it's super advantageous.
Tax-free wealth has a list of questions that
there you go.
I refer back onto whenever I'm thinking about tax season.
So if you're at a point where you can afford a tax professional, find a good one. That would be my number one thing. If you're not at a point where you can afford a tax professional, I would say don't over-focus on taxes. Think about the other costs of doing something just for taxes. For example, S Corps or LLCs. There's other costs that you need to consider. So have a holistic view, not just taxes, but also administrative, like how much of your time is it going to take? Think about all that. That's what I would pretty much say.
Yeah.
And I guess, I don't know if you're going to cut this, but is it just like who's listening to this exactly? Is it W-2 people, you think?
So I have like quite a bit. So I have like 16,000 followers on TikTok, and then Instagram we have a bunch of college students. TikTok, it's like a lot of like, yeah.
Wait a second, are we talking about like 50,000 people listen to this?
16,000.
That's a lot of people, dude.
Yeah, not all of them tune in, but like some of them.
So
do.
Thousands of people.
We'll give it thousands of people.
Holy crap. But anyways, one thing I would say is retirement accounts are a huge deal.
Yes, I definitely
any
agree.
Sort of, yeah. What did you say?
I definitely agree. Like
Yeah,
I always
401
recommend Roths.
Good.
401ks.
Yeah. 401k, like anything employer provided, take advantage of it. That's a big thing. I think a lot of people don't. Health savings accounts, those can be very valuable. Yeah. The college savings one was a 529.
I think those kind of suck for like tax event, like because like then you get screwed out of like FAFSA, I think, or something like that.
Oh, okay. I don't know about that, but yeah, 529s. A lot of rich people use those. We can talk about how rich people use this stuff too, if you want.
Yeah.
But yeah, I mean, like rich people use Roth IRAs, but in big ways, right? So I think that those things are huge deals, and I think we can get close. But I would say take advantage of all those little things.
Yeah. So a good thing for anyone recommending, I really always recommend this book that I've given out to so many friends. It's called I Will Teach You to Be Rich by Ramit Sethi. If you're wanting to know a little bit more about, I've talked about it like 10 plus times already. He talks about things like credit cards, banks, retirement accounts, automating your system, conscious spending, the mentality within spending, the mentality with retiring, how to live a rich life, how to live your rich life, and how to just think about money less while doing more with it. So I think that's like the ultimate goal with everyone. I think it's a great resource. It's made slash saved me roughly anywhere from 30,000 to 40,000 at this point, and it's a great book. Can't recommend it enough. It's I in my opinion, it's way better than like a lot of the Rich Dad Poor Dads or like Think and Grow Rich, because I feel like those are good for like getting your mentality right, but they don't have enough practical tips. They don't have as many practical tips as this book does. So, and he's kind of funny too. He kind of jokes around in the book. He's like Aruhn, making our class entertaining.
Cool. Yeah,
Uh,
I mean, I haven't read that, but I know the guy, so
you know him?
not personally,
Oh,
but
okay.
I've
I
seen
was like,
his
dude.
stuff. No, I don't know him
I
that
was like,
well.
connect me.
Didn't he have a Netflix show or something?
Huh?
Was he the one with the Netflix show?
You might have been.
Okay.
I know he's doing some pretty big things. But
I would also say, if you want a real plug for like a tax nerd thing, there's a book called like Aggressive Tax Avoidance for Real Estate. Maybe Google it before I plug it, because it was published in like the 90s, bro. But it was it's illuminating if you want to know more.
what's it called again?
It was like Aggressive Tax Avoidance. Let me look it up. John Reed. Let's see.
John T. Reed.
Yeah, the 20th edition. I don't know. You got to make sure it's somewhat updated, because it may not be after the tax cuts in 2017.
So, Aggressive Tax Avoidance for Real Estate Investors by John T. Reed. It was originally published in 1983, but there are different
20 editions now.
there are 20 editions.